Good evening. Thanks for coming. I also want to say thank you to Dorn for putting on the small cap event. There's not a lot of venues for smaller companies to have a chance to reach investors and especially talk to them personally. I think we have another great event tonight. 15 minutes goes really quickly, so I'm going to tell you what I'm going to try to cover, and hopefully it goes quickly on your end as well. I'm going to give you an explanation of what our company is all about. I'm going to talk a little bit about our previous results and our plans for the future. At the end, I'm hoping you'll end up with an investment thesis for why you should consider investing in Rifco. Yes, we have a disclaimer as well. We contain some forward-looking statements, and those have uncertainty. You'll be pleased to know that our company is very easy to understand. We loan money for Canadians to purchase cars, trucks, vans at car dealerships, both franchise and independent. It's pretty simple, it's car loans. I'll give you an example. John walks into a dealership in Hamilton, falls in love with a blue F-150. He wants to buy it. He talks to the business manager. John might not have perfect credit, but the business manager takes his information and decides he's going to send it off to Rifco. We take a look at the application and we determine we can approve this credit. We determine a rate, down payment, term, all that other conditions. We communicate that back to the dealership. The dealership then can print the loan documents right at the dealership. The customer signs it, gives a void check, proof of income, all that kind of normal stuff. It gets sent to Rifco. We pay the dealership for the vehicle. Then we take payments from the customer every month via their bank account. It's car loans. If you've ever had a car loan or a lease, you understand what we do. Rifco has over 40 employees. In 10 years, we've granted over $250 million in car loans. Today, we have about $120 million of loans that we're looking after. We were profitable this year. We've been profitable the last 6 years. Every day at our office, over 100 credit applications come in. On a busy day, over 300 credit applications come in. Our sales and marketing efforts are directed right at the car dealerships. Like our competitors in this space, we focus on the dealer channel. And that's because the dealer is who determines where the credit applications end up going and where the ultimate loans end up. So if you've been at a car dealership and applied for a loan, you might hear something like, we're getting a great rate from the local credit union right now. Or, hey, I got good news, you only need to put $500 down. They're directing the traffic of the car loans. And they direct it to us, and sometimes they direct it to our competitors. These are our competitors, TD Bank and Scotia. They're good at what they do. I'll explain how we compete with these very large organizations. But first, let me talk to you about the niche that we operate in. This chart's a little busy, so I'm going to go through it. At the bottom, you'll see bars representing credit scores. So on my left, your right, you'll see the scores of 850 and above. That's a really good credit score. That means you're going to get the best rate on whatever you want to borrow for. You'll notice that's a pretty small bar. You'll also notice way over on the other side, there's people with no score or a very low score. Those people are typically going to have trouble getting credit or are going to pay a higher rate. In Canadian auto finance, sometimes we refer to it in the industry as letter grades. There's A credit or B credit, C credit, or even D credit. Or we'll talk about prime credit, non-prime credit, subprime credit. You might have heard all those terms. I want you to note something here really quickly. 37% of Canadians have a score below 700. They're not prime credit, 37%. The blue in the middle there is the part that we operate in. We don't do super prime or prime. We also aren't the lender of last resort. We turn down over half of the credit applications we see. We focus in the middle. We lend to average working families, people that pay their bills on time and have jobs. That niche is about 33 to 36% of Canadians. That's who we target. We're in this niche because it's the most profitable niche. It's been very good to us. Our $120 million worth of car loans that we currently have yields us over 20% a year. It also delivers outstanding credit performance, very good yields, very low delinquency. We achieve this by using common sense, technology, and we hire great people. We work to be consistent, professional, and conservative in our lending. Now, I told you how we were going to compete with these big bad banks. Well, first, we have a great process for finding car dealerships that share the same kind of values as us. They're looking for something long-term, not the lending tree model where every credit application goes out to an auction. They're looking to find somebody they can deal with. They'll give them great service, great credit approvals day after day. If a dealer loves dealing with the big, huge bank, they're probably not going to work great with us. So we're focused on finding a different group of dealerships. We also employ less automation than maybe the big banks do. We're less rigid. And we also like to believe we employ more common sense. We also take great care of our dealers. When we find that dealer where everything's working well, we invest a little extra resources. Remember that it's that car dealership that directs where the credit applications go, who gets the ultimate loans. So let's say we're working with a dealership and they like dealing with Bob at our office. Well, why wouldn't we rearrange things so that they can deal with Bob all the time? Why don't we assign Bob to his account? Why don't we put Bob on a plane and fly him to the dealership so they actually can meet face-to-face once in a while? We do this. This is different than our large bank competitors. We also try to do things differently in other ways. For example, when we go into a dealership, we have high expectations for them. We have expectations on the performance of their book of business, on how efficient we're going to be dealing with them. We communicate those expectations, we measure them. We also offer very large expectations. So we ask a lot and we offer a lot. When it works, the dealership and Rifco will both say it works fantastic, but it does take more investment. Now, we are lending a little more than $2 million a week now to dealerships across Canada. In order to do that, we need lots of access to capital. We're in a very good spot right now with debt and securitization facilities. And in order to fuel our growth, we need to continue to be able to access more capital. We made an announcement this week. I'll talk a little bit at the end that is good news along these lines. Now, this marketplace is huge. So let's start with the auto industry. I think we all recognize that the auto industry by itself is a huge industry. The auto finance part of the industry is also large. Now, even when you get down to the non-prime, the part we operate in of the auto finance, it's still a $4 billion a year business in Canada. It is a huge marketplace. There's competition, but in such a large niche, there's room for us to keep growing. So there's a market share pie there. You'll note we have a really small market share. We've been growing really quickly, but it's such a big niche, we still have lots of room to grow. At Rifco, we understand that the management team are managers, that the shareholders actually own the company. We work for the shareholders. One of the things we do every year is we set objectives, we put them in the annual report, and we're going to measure how we do every year against those objectives. Sometimes it goes really well and we hit the targets, and sometimes we struggle a little because of maybe missteps or economic circumstances. Last year we published 5 targets. We hit every single target. I'm going to tell you about the targets we're setting for this year. Loan originations is a term that we use in our industry. It just means how many new car loans we've granted. Last year we granted 68% more than the year before. Pretty aggressive growth. Our target for this upcoming year is nearly $100 million in new loans granted. We like to grow. Finance receivables. That's the loans that we have on the book. So that's new loans being added and people paying down their loans. Those are the loans that pay us interest every year. We exceeded a $100 million book of business last year. Our finance receivables grew by nearly 50%. We're targeting very strong growth again. Our finance receivables to exceed $145 million. Remember, this portfolio pays us 20% a year. So you can determine what our revenue will be by how big our book of business is. Speaking of revenue, as our receivables increase, revenue increases as well. Revenue increased $5 million a year last year. You heard an earlier speaker talk about companies with revenues. $5 million increase in revenues. We're forecasting a $6 million increase in revenues this year. And then how does that affect earnings? Profits. That's the stuff that's left over for the shareholders, right? These are quarterly earnings numbers. 2, 3, 4, 5 cents a share. That's our last 4 quarters. It kind of looks like a trend. As our loan assets increase, revenue is going to increase and earnings per share is going to increase. It's very predictable. You can see that the company has hit critical mass and that we're seeing strong earnings growth. 23 cents a share is what we're targeting for our current fiscal year. As you saw, we've already reported 1 quarter of our fiscal year, which was 5 cents a share. With growth, we're very confident 23 cents a share is going to be a target we are going to be able to hit. Now, I presented at the Vancouver Small Cap Conference in October 2010. Some of you might have been here. Rifco was trading at about 54 cents at the time. I told the audience then that we have a great company with a great future. We came back the next year. In 2011, we were trading at about 92 cents then. And I told the audience we're a great company with a great future. And I'm back now. 2012. The stock's gone up a little actually, and I think the last few days we've gone closer to 240, but I'm telling you in the audience, we are a great company with a great future. Each of those Vancouver conferences, I also talked about something called platform value. And this is a little bit esoteric, but it's very, very important. We've spent the past 10 years developing systems and processes to allow us to compete and generate those high-yielding receivables with very predictable, very positive results. That's our platform. If you take our platform and funnel reasonably priced capital, it produces great profitability. The bigger we get, the bigger our platform gets, the more valuable it becomes. And why is it valuable? Because not only can we generate profits for you, the shareholders, but also financial institutions that are much larger than us from time to time buy platforms for their own use so they can deploy capital. I say this because it happens on a regular basis in our industry. I got 2 examples because they're direct examples from 2006, 2007. You'll note that the 2 banks that I've already talked about bought independent companies so that they could deploy their capital through their platforms. I'm going to drill down a little bit on a company called V.RFC that was purchased by the Toronto Dominion Bank. In 2002, V.RFC was about 10 years old. Today, Rifco is about 10 years old. For fun, I've compared these companies. You'll see that in some of these comparisons, maybe Rifco does a little better. Maybe in some of these comparisons, V.RFC does a little better. These are important metrics in our industry. In 2006, so 4 years after this point in time for V.RFC, they were purchased by TD for over $300 million. Rifco's market cap today is about $45 million. We're generating tremendous platform value. Now, I promised you an investment thesis. If I haven't done it already, hopefully I can sum it up quickly. I believe that Rifco has recent success, but has tons of runway. The best is still ahead of us. Every metric for us is improving. We're profitable, we're growing. At some point in the future, there may be a catalytic event that will release tremendous value for our shareholders. Now, I did mention a press release on Monday, and I'm going to go over this really quickly because I bet I'm out of time. Wells Fargo funded us on Friday on a facility, $70 million. This is a transformational transaction. This replaces a $10 million facility we had with a Canadian bank. It's very important because it's a 3-year committed facility. It takes away any potential funding risk. It lowers our cost of funds, increases our flexibility, and opportunities for much larger transactions for Rifco are now available. A $70 million facility. I will let you know Wells Fargo is the largest, most predominant funder of auto finance companies in North America. They fund over 100 companies North America wide. We see this as validation that we're doing something right. If you're not yet have Rifco on your watch list, consider adding it. If you would like to receive periodic updates, go to our website at rifco.net. We'd be pleased to email you updates, and of course you can withdraw your subscription at any time. Thank you for your attention.